Hi everyone, it's Anita Marshall from Advanced Finance Solutions, and I would like to introduce you who I feel is the best accountant that you're ever going to come across.
Thank you.
Ish from my Infinity Business Advisors. So, as you know, I swapped to Ish about 2 years ago. He's totally amazing. He's saved me a lot on tax. He's changed a few ways that I'm doing things, which has really benefited my business. Cannot recommend Ish highly enough. So, thank you.
Thank you. All right. From a presentation, obviously, I'm not going to tell you what I do as an accountant. We all know what accountants do. There's a very important message I want to pass on to you guys. And obviously, you guys would have seen these on some of your chairs. There's some more in the middle. The message is, how many of you guys here have thought about succession of your business or succession about your wealth? How many of you got a will in the room? So there's a few, I think there's a fair few those who don't. And how many of you have thought in your business, if something happens to you as a business owner, and if you're not able to go to work for a couple of weeks, who is going to look after your business? Who is going to pay your staff your wages? So that's a very important message for you guys to take. What it says on this piece of paper is legacy is an amount of money or property left to someone in a will, or something about business succession, wills, and EPOA. It's not about me doing it. It's about me telling you what's more important for you from a business owner's point of view or an individual, because at the end of the day, you guys are building a wealth for something for future. And if you don't protect it now, what's the point? So that's one of the key things I want to take. Next. Yeah, should be wrong.
Just the arrow, isn't it?
Yep, should be the arrow. Glenn?
Oh, I can just do it like that.
Okay, so the next slide is a disclaimer. It's about, I'll go through a couple of case studies and few tips and things like that. It's not in specific to anyone. It's just in general in nature. I'll talk a little bit about the superannuation product. The superannuation guy is there. You can ask him more about it. For me, it's more about what are the tax benefits at the end of the day. Next. Now, that's our small team based in Miami. So it's a couple, Andrea and Ellen, my business partner, Edwin, Yin, and my wife, Suzanne. She looks after the admin. You don't really see her in the office. All right, next. Now, what kind of clients do we look after? We look after everyone and anyone. I think I've got a client of each and everyone in this photograph up here. Next, Kim. So that's my family, my two boys, just 21 and 22, nearly finishing their university and apprenticeship. Next. Okay. So I thought I'd just share with you the common question I normally get asked, or when I meet a new client, I want to know, what is your business structure? Everyone says it's a company. Well, is it a company on its own, or is the company a trustee, or is it just a business name and people call it as a company? And I thought I'd just share in general what it really means between the two, and how do we look at the different factors when we meet a client and when they say, I got to ask a question, I want a company, how much are you going to charge? Well, it's not a simple answer. It's what do you guys want to achieve? Are you guys bringing on investors, or is it just a family working together and a small family business? It dictates from their point in time. So this is a trust structure where we can have company as a trustee or an individual as a trustee. The trustee is the person who runs the business in the trust. And whatever is the profit in the trust, it gets distributed to the family members only. You can't distribute it outside your bloodline unless it's really specified in your deed. Now, in a company, the business runs up here. The profit of the business can be paid to a shareholder, which could be an individual or could be a trust. If it's a trust, the benefit is then you can share the profit with your family members. Sometimes you got to go for the company because you want to bring external investors along and people want to put money into your business. So things we look at is it for the tax, family, do we need capital, asset protection, estate planning. In estate planning, the assets of the trust are not part of your estate. They are part of the trust. It's only if you got shares in a company, they are part of your estate. So it's a matter of knowing what do you want to leave for your future. Can you sell the business? How long do you want to run the business? And what kind of business are you be running? So some businesses you can't run through trust. It's like where you got R&D concessions to be available. They have to be done through a company. Next. Just in a nutshell of what it really means. In a company, 25 to 30% tax. In a trust, the profit has to be distributed to the individuals, and depending on how many family members. Asset protection, obviously, it's a trustee company, the director with the low net assets, and same thing with the company. The key person on the company side is the director and the shareholder. On the trust side is the appointer. The appointer is a very key person when the trust is established. To give you a simple example, I think Clinton might have heard of it. Years and years ago, that's how I was taught when I was learning about trust. An old man was passing away, and he had a lot of assets in his trust. The daughter came to the father and said, "Dad, I'd like to be the appointer." And the son said, "Dad, I'd like to be the trustee." The father says, "Good, problem resolved, no issues." Once the father passed away and things settled down, the daughter passed on a minute and said, "Resign, remove the trustee, because that is the biggest power the appointer has got." And she made herself as a trustee. Yes, there are other issues behind it, but you can see you got to see who is the appointer in the trust, because that's the person who rules. Companies can long forever and a day till the day they're deregistered. In trust, the trust is only 80 years. From the tax office point of view, this is very, very big thing is when the company director takes the money from the company without paying tax, not as dividends, just as a loan, it needs to be monitored. There needs to be loan agreement. It's a very, very big thing with the tax office. And something new starting this year is the trust distribution. When people distribute the profits to the kids over 18 or other family members, the tax office want to see, is the money flowing to them? Or is the money being really used by the current business owner and not been given to others? It's just next. Now, very important for us at this time of the year is tax planning. So why is the tax planning so important? Because when you go trust, you want to share your profits, you need to start thinking about it now. Who are we going to flow the cash to? It's about managing the future cash flow, because obviously if you got a big profit, you need to see at a point in time, you'll have bigger tax installments, you need to put it away, when it's going to happen, and how are we going to manage it. Manage your company's surplus cash. Do we need to declare a dividend? So it's one of those important things to think about. Because the company is capped at 25 to 30%. Why I say 25 to 30? For a trading company, it's 25. If it's an investment company, it's 30. Now, when we work, we normally look at a bigger picture, and I'll show you an example next of how the profit can be shared amongst the family. And obviously, got to start thinking about your retirement, because that pot of gold doesn't fill in a couple of years, unless you're selling a business for a big price and you can fill it quick. Otherwise, it takes a lot longer. Now, what I've done here is just a simple worksheet of when we meet with the clients and we discuss their tax positions. Like mom and dad position up here, dad has got shares in his employer's company, and we normally show them, okay, this is what it is at the moment. Mom's income is lower, dad's income is higher, so this is the bottom line. This is a very basic example. Next slide. So what we did was we had an opportunity to transfer those shares or sell those shares into a family trust. So we transferred the shares in a trust. So the benefit it gave us was now that the dividend, instead of being in dad's name, has gone in mom's name up here. So what's really done is, yes, it's a smaller bill, but compared to what it was, it's reduced. So that means overall in a family size, you nearly save $4,000. Next slide. So what happened was when the child turned 18 the year after, so we decided rather than share the profit with mom, and child only had a job at McDonald's, so the profit went up here because the child needed to buy a car and the parents were going to help him anyway. So we gave the profit to the child. So what is done is, so basically we turn the whole circle around. Sometimes it's not possible. It's more about thinking outside the square and how we can help. So this is a very, very simple, plain example. We can even look at a bigger family structure, mom, dad. Sometimes you don't touch the parents because the parents have got a Centrelink pension. You never do that. Unless you want to put them on a wage or something like that in a company, that's a different. But it's mainly the child, because parents do help our kids from the age of 17, 18 when they're still working or at uni, buy a car or something. Or always there's some support, or I'm helping my child with a bit of fuel bills or reg or insurance. So all the bills you're paying for them, that's the share of the profit they can get through the trust. Next. So as you can see, it's one of the straightforward, isn't it? Next.
No, it is three.
All right. Just few year-end tips. It's very important with the tax tips. Always got to think through well in advance. You can't change once the clock takes 1 July. So that's very important from financial planning point of view if you have not used your limits every year. You can do a write-off in your businesses of any cars or things like that you have bought or any other items. Sometimes people forget they sold the assets a few years ago and their capital losses and they got capital gains. Do that. Something that has changed, working from home. Before, people would just say, oh, I work from home 1 day a week. Tax office accepted it. But now they want to see your diary record as of 1st of March. Obviously, if people have got cars in the business, if you maintain a logbook, it gives you much better outcome rather than just going down the standard method of the tax office. Any expenses that need to be paid. Very important, as I said, the word Division 7A earlier, that's about reducing the director loans. It's very important because if you don't do it and you ignore it, if tax office picks it up, they're going to declare an unfranked dividend. That means you're going to pay more tax. Get your staff super done before 30th of June. Because at the end of the day, yes, you're going to get a deduction on 28th of July, but it's next year's deduction. But if you think this year is good, pay it off just a week earlier. Sometimes people tend to run their mock payroll and see how much superannuation it would be. Let's get it done. If there's a small amount left, at the end of the day, you can just do later. Write off the bad debts. And obviously, if you can find a hybrid car under 84, the benefit is no FBT, and you can write it off. Next. So some of the common questions I get asked all the time. Is the money in my bank my profit? Can I take it? No. I've paid my loan. Can I claim that as a deduction? No. That's just a payment of capital. It's not a deduction. Can a person running the business in their own name, can I take a wage and put it through as salary and wages? No. Sole traders, the profit at the end of the day is theirs. They pay the tax. Yes, they can take a set amount from the bank account, if it's a business account, into the personal for spending purposes. But at the end of the day, they don't have any limit. It's whatever is the profit. Some people buy a lot of stock before 30th of June because they want to reduce their profit. But stock does not reduce your profit. It's an asset of the business because you're going to sell it and make money in the future. People often question, why do I have to declare the dividends in my tax return? It's a common thing. Yes, it's an income. It's an asset you're holding. It's derived income for you. You need to declare it. Yes, assuming it's got franking credits attached to it, you get the benefit of it. Quite common. I work from home during the COVID. Can I claim tea, coffee, and rates and other things? The answer is no. If you want to start claiming rates and other things, are you happy to give tax office a share of the profit in the future when you want to sell it? Do we want to do it? No, we don't. And the very other thing our tax office knows about, a lot of people are dabbling in and out of crypto. When we pull a report for the clients, it will tell us a message. Client has done work in crypto. That's it. Please check. And when you ask clients, oh, yes, I just put a little bit of money in. But what they've done is they put it in, they buy a certain coin, oh, they don't like this, they sell it, they buy something else, they sell, they buy. So there's so many transactions in the background, or I never took money out of it. But you bought something, you sold, you bought something in the same platform, that's technically a sale. So it's very important to report it. So even if you guys didn't make any money, it's best to report a loss. At least you can carry forward the capital loss. Now, what it means for us to be an advisor. So we don't treat you as a number. We look after you. We're there for you, and always there to put a plan there for you. It's more about how we can help you think differently. It's more about finding a solution. If you can't find a solution, we'll let you know that's how it is. We don't have a choice. Obviously, the money has been made because people tend to spend the money as they go along through the year. Comes the end of the year, there's no cash in the bank, so you can't do much of a strategy. And as we all know, the fine is a tax for doing wrong, and tax is a fine for doing well. Thank you.